So let's get started. In today's episode, we'll discuss the guardrail strategy in detail. We'll start by explaining what it is and where it came from. Once we have the basics covered, I'll provide a practical example for better understanding. I'll share my insights on the strategy and explain how I prefer to use it, followed by a concise summary to wrap it all up. The guardrail withdrawal strategy, also known as the dynamic distribution rate strategy, was developed by financial planner Jonathan Guyton and Professor William Klinger. It's a flexible withdrawal strategy that requires you to change your withdrawal rate based on the value of your portfolio. So basically, the amount you can withdraw will fluctuate with economic and market conditions. You will set a high guardrail and a low guardrail based on your initial target withdrawal rate. If your withdrawal rate goes above or below the guardrails you set, you would reduce or increase your withdrawal amount so you end up within the target range. Imagine driving on a highway with guardrails on both sides. If by chance you accidentally veer off the road and hit one of those guardrails, it might cause some damage to your car. However, it serves as a vital purpose by preventing you from going off the cliff and guiding you back towards the center of the road. That's precisely what the guardrail strategy does for your retirement. It acts as a protective measure, ensuring you do not run out of money during your retirement years. Here's another illustration that may resonate better for you. If you picture a railroad track, the initial target is the dead center of the track. You will then set guardrails on each side of the track, positive on one side and negative on the other. As long as you are within the tracks, you are fine. However, if you cross over the rail, you'll need to make adjustments. Again, you start out with your initial withdrawal rate, then you will adjust the rate as your portfolio changes. You should run the test at least once a year. By establishing upper and lower limits to withdrawal rates, this strategy helps individuals strike a balance between enjoying their retirement lifestyle and preserving their assets. It allows for adaptability in response to market fluctuations and life changes, providing a practical framework for managing withdrawals. The guardrails withdrawal strategy can play a pivotal role in retirement income planning, as it offers a tested framework for managing withdrawals throughout one's retirement journey. This strategy may hold particular appeal if you wish to reduce your withdrawal amounts during bear markets in order to reduce your concerns about depleting your retirement savings. In contrast to a more rigid and static withdrawal strategy like the 4% rule, Guardrails provides a sense of security by lowering the risk of running out of money in retirement. In addition, this approach may allow for a higher initial withdrawal rate for those trying to maximize their income during the go-go years of retirement. Per Guyton, if you are willing to have an allocation of 65% stocks and 35% bonds, you can start with a withdrawal rate as high as 5.4%. If you prefer a 50-50 portfolio, the starting rate can be as high as 4.6% per Guyton. However, I personally prefer a little more conservative withdrawal rate and would suggest keeping a 65 to 35 portfolio at no more than a 4.5% initial rate and a 50-50 portfolio of stocks to bonds at no more than a 4% initial rate. This will allow for a more smoother withdrawal amount throughout retirement and should allow you to adjust for inflation along the way. Research and analysis has shown that if you begin with a withdrawal rate that is too high, there's a greater chance of needing to withdraw a much smaller amount later in retirement, especially if you retire during the beginning of a bear market. The most widely used guardrail approach involves an increase or decrease in the rate of withdrawal by 20% before changes need to be made. If the rate of withdrawal crosses over the 20% threshold, spending can either go down 10%, which is called the capital preservation rule, or it can go up 10%, which is the prosperity rule. Note, when it comes to adjusting for inflation, Guyton's rule states you do not make an inflation adjustment if your portfolio returns are negative and the new withdrawal rate would give you a withdrawal rate that is higher than the initial withdrawal rate. He also says that the max per year you can use is a 6% inflation adjustment. So let's look at a guardrail withdrawal strategy example to help better explain how it works in an average bear market. You first select an initial withdrawal rate. Let's say you're okay with a 50-50 stock to bond portfolio, and you can go with a reasonable 4% withdrawal rate in year one. even though guidance study shows you can go as high as 4.6%. Next, you have to determine when to adjust your withdrawal rates, essentially acting as your own guardrails. A commonly used approach is to set the limits at 20% above and 20% below your initial rate. In your case, since your initial rate is 4%, your lower rate limit would be 3.2%, and your upper rate limit would be 4.8%. If your withdrawal rate falls outside your guardrails, you would increase or decrease your withdrawal amount by 10%, which should get you back into your target range of 3.2 to 4.8%. Let's say you have a $2 million portfolio and you happen to need $80,000, which is 4% of $2 million in year one, not including any other income like Social Security, pensions, etc. In year two, your portfolio drops 20% to 1.6 million. So dividing 80,000 by 1.6 million gives you a 5% withdrawal rate. Since that's higher than your upper guardrail of 4.8%, you would reduce your withdrawal rate by 10%. So 80,000 times zero point 0.9 equals 72,000. To make sure this falls within the 4.8% rate, 72,000 divided by 1.6 million gives you 4.5%. You would want to repeat this test at least annually to make sure your rates are within the guardrails. Remember, guidance says don't adjust for inflation if your portfolio is negative and your current withdrawal rate is greater than your initial rate. If you wanted to adjust for inflation, however, which may be possible if starting out with a lower withdrawal rate, you would still need to make sure you are within the guardrails. So if inflation in year one was 3%, your inflation adjusted withdrawal amount would be 82,400 in year two. 82,400 minus 10% gives you 74,160. You would then divide that by 1.6 million, which equals 4.6%, which is obviously still below the 4.8% rate limit. Note, guidance says not to adjust for inflation in this circumstance. However, in my opinion, I find it most sensible to utilize the 4% rule as a starting point with a reasonable adjustment for inflation, and then, when necessary, make periodic adjustments using the guardrails. I personally prefer a retirement income that is more predictable. While I am comfortable with making slight adjustments during market downturns, I want to avoid significant changes that would negatively impact my lifestyle in retirement. I believe that starting out with a withdrawal rate that is too high significantly increases the risk of experiencing a substantial decrease in withdrawal amounts later in retirement. Keep in mind, the 10% reduction in withdrawals does not necessarily mean a 10% reduction in overall income, because your Social Security income, possibly pension income, and any annuity income or other income will not decrease. Additionally, the reduction in withdrawals, if taken from your IRA, will lower your income taxes. Flexibility in spending is not new to any of us, as most of us have had variations in our income over the years due to various life events. By implementing the Guardrail withdrawal strategy, you can continue to maintain your lifestyle while you're also ensuring you do not deplete your retirement savings too quickly. There are several factors you may want to consider when using the Guardrail strategy. First, if you decide to use the Guardrail strategy, it's important to understand your own ability and willingness to adjust your withdrawal rate and income throughout retirement, especially during bear markets. If you were to tell me that you do not want to adjust your spending in retirement whatsoever, then this strategy may not be for you. Second, if you like the strategy but also desire to leave a minimum financial legacy to your heirs, favorite charity, etc., you may want to lower your initial rate. Third, you may want to factor in baseline spending needs and variable spending needs to make sure your initial rate covers all of your living expenses. So, to summarize, in this episode, we looked at the Guardrail withdrawal strategy, also known as the dynamic distribution rate strategy, which is a flexible approach to withdrawing funds during retirement. The strategy was developed by Jonathan Guyton and allows retirees to adjust their withdrawal rates based on economic and market conditions. The guardrails used in this strategy involves an increase or decrease in the rate of withdrawal by 20% before any changes need to be made. We also learned that starting with a withdrawal rate depends on the retiree's allocation. For instance, if you're willing to have an allocation of 65% stocks and 35% bonds, per guidance research, you can start as high as 5.4% And if you have a portfolio of 50-50 stocks to bonds, the starting rate can be as high as 4.6. But once again, I personally would be cautious about using guidance maximum starting withdrawal rates due to the sequence of return risk you may face during the first several years of retirement, which may cause a much smaller withdrawal amount later in retirement. I suggest a reasonable starting withdrawal rate of no more than 4.5% for a 65-35 portfolio allocation and no more than a 4% for a 50-50 portfolio allocation. It's important to note that different opinions may exist, and it is perfectly acceptable to have differing perspectives on this matter. The suggestion I am offering is based on my own opinion. Note, if you're opting to delay Social Security for a few years and find it necessary to withdraw a larger percentage before Social Security benefits kick in, that can be acceptable and warrants a separate consideration altogether. I believe the Guardrail withdrawal strategy is an innovative approach to withdrawing funds during retirement. It provides you with the flexibility you need to adjust your withdrawal rates depending on economic and market conditions. By using guardrails, you can maintain your financial stability and avoid making rash decisions based on market fluctuations. The strategy is definitely worth considering for those who are okay with reducing their overall withdrawal amount during market declines. It's also important to acknowledge that there isn't a single perfect withdrawal strategy. Every solution has its strengths and potential weaknesses. Only by gaining an understanding of the possible approaches, then combining them into a personalized solution, and still accepting some risk, will you be able to move forward and enjoy retirement. Next week, I will look at the four main types of retirement income strategies, which were developed by Dr. Wade Pfau, a renowned retirement planning expert, to help you figure out which one fits you the best.